So now let's get to kind of some of the fun stuff, which is actual investments, right? You hear everybody talking about investments, you should be investing. Okay, that's great, but what should you invest in? What is going to give you the type of return that you want? And what's not going to be, what's too risky, what's not risky enough for you? So it's really important to understand. So I'm going to cover 3 quick investment types and give you a really quick breakdown of how they work. So the first one is stocks, right? When massive companies, they can issue stock and you can buy shares of a company, which means you own a piece of a company. So if you want to go out and buy Apple, I have an iPhone, I like Apple, so I could buy a share of Apple stock. And what that means is I think that Apple as a company is going to grow. And if I own a piece of that company, even if it's a really, really tiny piece of that company, that piece is going to grow just the same as the entire company will grow, okay? So there's a lot of different stocks out there, obviously, and they range from very speculative or very risky to stocks that companies you know really well, right? The major brands that you probably buy from and consume on a daily basis. So that's stocks. Now, they're a little bit more risky because companies can go under. Has anybody ever heard of Blockbuster? You probably were too young to ever go to one and pay their late fees, but I wasn't. I went there. Blockbuster doesn't exist anymore, right? If you were invested in Blockbuster, then you would have lost all of your money. Okay, so there is risk to investing in stocks. They're not always going to go up, but in the long term, they do increase. Okay? The second type of investment is bonds. Now, a bond is basically just a loan. Okay? But instead of you taking the loan, you're actually lending money to somebody else. So there are companies out there that maybe they are trying to raise some money and they want to borrow some money. So you can buy a bond, okay, you give them money, and they give you a promise that they'll pay you back with interest, which is great. So depending on the type of company, depending on how long that loan is for, the interest rate you're earning is going to be higher or lower, okay? And the risk is going to be commensurate. If you're earning a high interest rate on that bond, probably it's a riskier bond, or there's a chance the company might not be able to pay it back. If you're earning a really low interest rate, then it's probably a fairly safe investment because they're confident that they can pay you back. So what is commonly done is in your investment portfolio, you would have some stocks and you have some bonds, and they balance each other out. The bonds are less risky, but they grow less. Stocks generally are a little bit more risky, but they grow a little bit more. So depending on what kind of rate of return you're looking for and how much risk you can tolerate, then you just find the right balance for your portfolio to grow long term. Now, one easy way to do this, and the last investment type I'll mention, are mutual funds. Mutual funds are managed by companies. They have a fund manager, and he makes the decisions as to what stocks or what bonds go into this basket called the mutual fund. So instead of you going out and picking individual stocks or individual bonds to buy, you can go out and buy a mutual fund that has a mix of the types of stocks you like and the types of bonds you like. And that way you don't have to manage it nearly as much. They're managing it. You pay a very, very nominal fee each year out of the investment return for them to manage it. But it's a very easy way to get invested and be diversified and still grow for the long term. When you're picking one stock or two stocks like we talked about, if you pick Blockbuster, then you lost a whole lot of money. So it's important to spread out your investment over a number of companies so that it's diversified. If one goes under, it's okay, you have all of these others that are still increasing. So those are stocks, bonds, and mutual funds, and we're going to cover more of that in this module.